this guy's not smarter than me, better, not a better salesman. And the truth is, you just have to be, you got to be better. You got to be first, or you got to be more creative, or just outlast everybody.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast. Hey guys, welcome to the Legacy Podcast. I am Tim Bratz. Today I'm here with my buddy, long-term buddy from Ohio, Tarry Summers. He's a rock star, single-family investor, and owns some other commercial properties too. He's an equal opportunity investor, I think, looking
Yeah,
for
there we go.
great deals all over the place. He also owns some businesses and has a lot of really, really good stuff going on. So he is an authority in the Columbus, Ohio market. And Terry and I are members of some common mastermind groups and just been great friends for a long time. So, dude, excited to have you here. Thank you for being here, buddy.
Excited to be here, man. I
Yeah,
like the
man.
equal opportunity investor. That was
That's
good. Did I come up with that, or did you come up with that?
I did. I did. You could borrow it though,
I,
as long as
I'm
you give
going
me
to
credit.
borrow it
Yeah.
with interest.
Many people know who you are through social media, but let's share a little bit about your background, a little bit about your story, kind of how you got started in real estate and what you have going on now, because you have a sizable portfolio today and a lot of really good stuff going on. And there's also some changes, adjustments, improvements that you're making in
Yeah,
your business in order to constantly refine and improve things. So let's hit on all that, man. Give me a quick rundown of all those things.
yeah, for sure, man. So equal opportunity investor out of Columbus, Ohio. Love that again. But yeah, today we have 276 single family houses. I've owned apartments. I own a couple commercial buildings in like the downtown area of Columbus as well. I kind of like doing like one of those maybe every year or two. But really, it's been the single family thing. I mean, I started with one house. Was an FHA house hack, and we do houses originally because it's just what we're familiar with, what we know, and just went gung ho on the single family side. All the big stuff seemed scary to me, and I didn't know how to get into all that. So I just stayed in my lane for a really long time. I've officially house hacked, I think, like 15 houses over the last like 13 years. My wife says that's no longer an investment strategy, that I actually have to like
Hey, we got
make
to
money
cut
in
that one
other
out.
ways. Yeah, that one's getting clipped. But yeah, fast forward to today. I mean, at one point I had over 400 units with the multifamilies and the combination of the single families. Um, so as this kind of grew, obviously you got to bring management in house, you got to get a team, you got to, start bringing construction in house. You have to start doing all these little things to start. I look at real estate as like this pie, and everyone's eating off of it, right? You have to start like buying or having more pieces of that pie to make your deals actually work.
Mhm.
So what was it, 2021? I decided to start letting go some of the multifamily stuff just to be more liquid, sit on cash. And what was cool about that, and selling some of my, I call it portfolio pruning, where I'm selling the top 5% of high equity single families and the bottom 5% of my headaches every year, just to kind of recycle cash.
Love it.
And in that way, when you go to a bank to get financing or whatever, you're not asset rich and cash poor. You can actually, you can just pull up your Schwab statement and they're like, oh, no problem, he's proof. Boom, done. So today, I mean, the market's a little weird, right? Especially in the single family space. I think it hit multifamily first, but we're just now starting to see values correct, rents starting to correct. All these houses that haven't been sold, people are saying, oh, we'll just turn them into rentals. Well, that's making the rental market compress, and now we're having to be better on rentals, having to, outcompete, have a better product at a cheaper price. So I look at it as more of like just being an investor, being a wave rider is kind of what I like to say. So you never want
Hmm.
to like start the wave, you never want to be at the top of the wave, but you kind of just want to ride it while
Yep.
it's fun, right? You never want to crash with it, you never want to start it. So that's kind of how I look at business in 2025, fast forwarding all the way to today.
I like it, man. I think you had a lot of good insights on that. I think a very simple yet profound thing to do in anybody's business is that Jack Welch policy of eliminate the bottom 10% every single year, right? You do the bottom, you said bottom 5%, I think, 5, ten
Yeah, about
percent
the
of
bottom five. Yeah,
yeah, of your portfolio. And so Jack Welch did it with personnel at General Electric, and he
yeah,
would take the bottom 10% of performers and remove them out. He'd bring in new folks. And, you know, if he removed all the 1 out of 10s, then all of a sudden, dude, there's a 6 out of 10 that pops in. There's an 8 out of 10 that pops in. There might only be a 2 or 3 out of 10, but that's still better than a 1 out of 10. Then there's still going to be some other 1 out of 10s that come in with that new batch. But
Yeah.
it naturally, man, created this amazing momentum effect in their organization, where it was just like everybody was achieving at a very, very high level, and it moved everybody upward. And we can do that exact same thing with our real estate portfolios. Like, why are we hanging on to these problematic properties that aren't making us any money? It's the 80-20 Pareto rule, right? It's like, you don't, you know, you can't like beat it. It's a law of nature that 80% of your headache is going to come from the bottom 20% of your
100%
portfolio.
always.
So you're like, oh, well, I mean, out of these 100 units, let me just get rid of the bottom 20 units. Well, now the 80 units that are left, same thing comes into place, right?
Yeah.
80% of the problem is going to be
Yeah.
out of that bottom 16 units or
And
whatever.
then 3 years
So it's
later,
like, it's something
an
that
A
you work
turns
with.
into, yeah.
Yeah. So you always refill and you get back up to that account, but you eliminate the bottom headache properties. And I like what you said, is that it wasn't just the ones that weren't profitable. It was the ones that were problematic, the ones that were a drain on you and your team, and getting rid of those and then backfilling it with other properties. Naturally, your portfolio is just going to grow in value, in ease of management, in quality over time by continuously doing that. I think that's a really, really profound thing to do in business. And I think it's something, when everybody's in growth mode, they're not thinking about trimming back or shedding or refining a lot of times. And I think it's a great reminder to do that, man. And I'm going through the same thing. I've been trimming back. I was at 4,800 doors, man. We're probably around 3,000 today. So, yeah.
You have to, man. And also too, you know, when you sell things, I used to call myself a buy and hoard investor. I just wanted to hoard properties. But the thing you don't realize, like, oh, why don't you just cash out refinance? Well, that gets you to 75% if you're lucky these days, usually 70. But that top end 25 or 30%, it's a lot of money, right? Like, once you add that up over X amount of units. And so being able to take all that and be able to 1031 exchange and other stuff, and you're leaving a lot of money on the table, right?
Well, that's the next, you know, I think a lot of people look at real estate and they say, what's going to be my return on investment, right? Once you own real estate, that equation is only good for the acquisition side. Once you own it, now it's, what is my return on equity, to your point.
Exactly.
So now you're calculating, okay, if I hold this property, it generates this much cash flow after all operating expenses, after all debt service, it brings in X number of dollars per month, per year. But if I sold it, right, it's worth 100,000 and I owe $75,000 on it. If I paid real estate commissions and some other things, I might net out $93,000. And so I really have about $18,000 of equity. Do I pay taxes on that? Do I 1031 it? If I put that as a down payment on something else, can I get a higher return than the cash flow I'm achieving on it? And it's not just cash flow; it's also principal pay down. You got to pay attention to. That's not dollars that you see right now,
Yeah.
but it's real value that you're creating, kind of a forced savings on an annual basis. And so you just bring these variables into play, and it's a math equation at the end of the day.
It is. It's almost like 5-dimensional, you know, because then you got to look at, like, how much tax savings have I created over this amount of time. And then another thing that we have to look at, I mean, you never want to bank on appreciation, but we're all, like, we talk about this all the time in masterminds. You have to buy in areas that have some growth component that are changing, right? Because we want our properties, if we're buying a B, we want it to be an A. If we're buying a C, we want it to be a B. And so you have to, like, almost like try to see into the future to some degree, right? And at least forecast and believe in the forecast to some level, right? And then decide, okay, is this a property I want to sell? Does someone else believe in this more than I do? I mean, I just sold my last apartment building the other day, man. It was like 40 days ago, to Children's Hospital. And they're completely willing to overpay because it's their social mission. And I'm looking at this apartment building. It's only 9 units, right? And I owed like 600 grand on it. They were willing to pay me 1.4 million for this apartment building. So there's 800 grand sitting there. I'm like, this thing literally brings in, like, cash flow, maybe like 2 grand a month. Like, what can I do with 800 grand versus 2 grand or 800, right? Like,
Yeah, $24,000
on
on 800,000. It's a 3% return that you were making on it.
I might as well just
Return on
put it in
equity.
the market and just let it sit. Right.
And
Makes
guys
zero
like you
sense.
and me, we know how to go out and do more deals. I mean, we're part of Mark's mastermind, right? Deal makers.
Yeah.
And so we know how to go out and create new opportunities. For some people, they don't have that skill set. But for guys like you who can go out and redeploy that money and make a 15 or 20% cash on cash type of a return, it's a no-brainer, man, to take your dollars off the table and move it into something that you can lever up even more, get more depreciation, create more cash flow, create more
Yeah.
principal pay down, create more long-term wealth.
And what was cool about that deal is I put now I want to say like 13 houses in contract. So because I looked at the taxable gain if I was to exit out of this 10 because it was part of a 1031, I was going to pay half of that in taxes. So I'm like,
Mm,
okay, let's buy a bunch more properties. I can borrow out on the back end and
hmm
then refigure the debt and kind of calculate that to where I can get majority of that 800 grand in my pocket and then, still have properties in the same thing over and over and over. And then I just keep, kicking the can down the road later.
I love it. I love it. And that's, dude, you're in New York City right now as we're filming.
Yeah,
When I started my real estate career, it was in New York City as a real estate agent on commercial side. And one of the things that I
that's right.
noticed was, bro, like these guys, these families would buy property. They bought properties in the 30s, 40s, 50s, and they owned them. And sometimes they just put it on like a land lease and leased it for 99 years, or they would rent it all out. They'd throw debt on it, and then every decade they would pull out millions of dollars tax free. They'd depreciate it down to zero, but they would never sell it because then they have recapture on that depreciation, and they would just pull tax-free money off the table whenever rates came down. They'd throw new long-term debt on it, refinance, pull millions of dollars off the table, and then they just wait on it for another 10 years. They'd reinvest
Yeah,
that
and it doesn't even matter at
tax-free
that point if
money.
they make money.
They'd live off of it. And that was the model. And the model was never, ever, ever sell. And when they pass away, the kids inherit the property at the step up in basis. And they get to do the exact same thing again, man. And that's how real long-term legacy wealth is built.
Dude, and when you have great buildings, 1000% agree, never sell them. But if you have
Agreed.
something that you're
Agreed. They got
like,
to be great buildings
hey,
though.
mate, yeah, they got to be great buildings because you got to own those problems over the next 30, 40, 50 years too. And then your kids have to own those same problems. But if you have something that in 5, 10 years, you're like, dude, let it go, right? And then move that into a great building that you can do that. But what's interesting about that is a lot of people do that. Just it's like a new way of thinking about it. But you're just pulling out money. Doesn't even matter if it breaks even in the meantime. But your cash out refi is your income. That's your income stream, right? Then you take that, move it to the market, lend it out, buy more buildings, whatever. But then that's your income. It's just
Yeah.
yeah,
Dude, it's an amazing, and it's here's the thing, man. There's not people smarter than you or me doing it, right? They've just been doing it for longer. They're further ahead, and or they're second generation or third generation, and it's not some crazy secret that exists. It's buying good properties in good areas with good debt that you in-house manage and you hold on forever, right? As long like that's the criteria. That's the buying criteria that we all aspire to be at. And I do think, right? I'm started in Cleveland, you started in Columbus, and we both started in rougher parts of the communities. And that's because, dude, we don't come from money. We had to kind of scrap and scrape and figure things out. And that's okay. It was a great stepping stone for us in order to get into the B class stuff and then eventually the A class stuff and then eventually the bigger stuff. And so it's just, you don't want to stay in that C and D kind of area. It's okay if you're transacting and trying to build up some cash and trying to build up some equity. But the reality is, that's not the stuff you want to hold on to long term. It's going to drain you from a time perspective. So once you buy that thing, you fix it all up, you rent it all out, dude, launch it, and then take the profits and roll it into something nicer, bigger, and better.
yeah. You know what? You said something, man. And I was going back to when I first got into this business. And the reason that I loved it is everyone that I looked at as a mentor, I'm like, dude, they're not smarter than me. Like my original mentor wore Wrangler jeans, and I think there were those rustlers from Kmart. You know those
Yeah,
rustlers?
yeah, yeah, yeah,
They have like the rustler on the back.
yeah, yeah.
And small house, just driving around this pickup truck every day. And dude was just living life. And I'm like, this guy's not smarter than me, better, not a better salesman. And the truth is, you got to be better, you got to be first, or you got to be more creative, or just outlast everybody. And that guy, he just outlasted everybody. It wasn't
Yep.
smarter, it wasn't better. You know, his properties are, but he stayed in the game longer than anybody. And I mean, you can live a very, very good life if you just keep in the business.
Well, I think that's the key. That's the difference because everybody wants to get rich quick. You see it on cryptocurrency, and you see it with forex, and you see it with the stock market, and you see it with
We
e-com
have to go
stores,
down
and you
this
see it
rabbit
with
hole.
dude all this other nonsense. That's like, how do I get as rich as I can in the next 12 months, dude? If you just extend out your perspective, you extend out your timeline on, I'm willing to give this 10 years. You don't get rich off of real estate right now, but you will get wildly wealthy if you dedicate 10 years to it. If you start buying stuff today, you say, I'm going to hold on to it for 10 years, and then we'll make a decision if I stick with it or not. Dude, it's insane how much property appreciation you get, principal pay down you get, the tax benefits that you get. Eventually, the cash flow grows, right, to a point where if it
Right.
increases by 3% every single year and just keeps up with inflation without some of these big jumps that we have seen, um, dude, just let that compound over 10 years and think about how much
Yeah.
more cash flow you're going to have 10 years from now versus today.
It's just so
And
hard for people to understand compound interest 10 years
it
into the
is.
future, especially like the people who are listening to this are 23 years old or 24 years old. You're like, man, what am I doing at 34? You know, that seems old to them, right?
Mhm.
And but you just got to stick in the game, man. Life
Dude, put
does
it in
go on.
an Excel spreadsheet and just watch the rents, just times 1.03 10 times
Yeah.
and see what happens to your rents. And by the way, your debt service stays the same, right? So just think about how much additional cash flow you generate if you can just stick with it. And so if you have the staying power for the first 3, 5, 7 years, and as long as it's break even and better, realizing there's some forced savings by paying down principal, there's some rent growth that you're going to get, and you're going to find some additional cash flow. You're getting a lot of tax advantages out of it, and eventually you're going to be able to refinance, pull a bunch of money out tax free. As long as you go in with that mindset, man, it's hard to lose in real estate. Like there's nothing else that's more time tested from a real estate or from an investment standpoint than real estate.
Fun makes everything a great deal.
Yeah. Yeah. Well, so what are you seeing right now? So tell me a little bit more. We talked a little bit about some of the quirks that's going on in the market. Dude, in what I've seen statistically, generally speaking, on a macro level in the economy and across all markets in the United States, is that inventory is still limited. It is there's a little bit more of a time on the market. Days on market have gone from a month to 2 months, and now they're at 3.5 months in most marketplaces now. But dude, that's
Yeah.
still a seller's market, right?
Yeah, it's different. So I mean, and for us, I mean, we're still flipping probably 40 properties a year, just traditional. If you buy, rehab, sell them. So like days on market, dude, it's definitely gone up. I will say,
What price point are you
but
in, real quick?
so price point, I would say anywhere from 220 to 350,000, which in Columbus, Ohio, like
So
anything
that's
under
affordable housing
is
in
affordable housing,
almost
right?
every market.
So, but it's like the tale of two economies, man. Like, and I think that like I mean, we've seen that like with just the general economy and how like if you look at Walmart, for instance, people are shopping at Walmart again. It's crazy. But over 350,000, those things are still going off the shelves. But if it's under 350, these people are picky, man. I mean, I'm talking, you're going to have a request to remedy list that's this long, just because there's not that many buyers, right? In that price point. So yes, you can rent these things out, but because everyone went with that model, that's been my model for years. It's like, I want to buy a house that's in a that's in an owner occupant neighborhood that I can still rent, cash flow, or at least have like a 1-to-1 rent to value. Um, Hopefully a lot better. Um, but then if I ever want to sell to an owner occupant, I can, right? So I have multiple exit strategies out of these single family properties. But now that everyone has decided, okay, I can't sell it for the price I need, I'm just going to go put long-term debt on it and try to make it a deal over time. Now there's a lot more rentals on the market.
Mm.
So instead of us, painting everything agreeable white, basic trim, white cabinets, all that stuff. I mean, we're having to do like upgraded lighting, like the same lighting fixtures you would see in a $500,000 house in a $250,000 house.
Wow.
Painting accent walls, vertical side, just all the stuff you would see in a higher end home, having to put that to separate yourself in these lower end homes. We're even going as far as to having to do this on some of our rentals now too. So if we're not getting any traction on the rental side on a single family house, we're like, dude, what do? We got to go in and do a landscape package. We have to go in and, maybe, start painting all our front doors this ugly pink color or this ugly yellow color just to make them stand out. But like
Yeah, have
doing
them
these
pop.
little things that we never used to have to do in rental properties, we're having to do now.
This episode of the Legacy Podcast is brought to you by the Legacy Boardroom Mastermind. So our goal is to give as much free information away as humanly possible through all of our social media platforms and try to help people with their businesses, help people with their lives. We also have something for people who want more one-on-one attention, which is Legacy Boardroom. Legacy Boardroom is a board of directors for your business. If you are doing up to about $10 million a year in gross revenue, you're making some money, you got some good things happening, but maybe you can't afford a C-suite of executives, of a chief marketing officer, a chief operating officer, a chief investment officer, a chief human resources officer, and you need access to these fractional C-suite executives. That's what this was built for, at a fraction of the price of what you can find anywhere else in the marketplace. So it's my actual team who have built multiple 7 and 8 and 9-figure businesses and real estate portfolios that is available every single day of the week on these daily boardroom calls. So any questions that you have, you can hop on, ask questions about operations to my COO, ask questions about acquisitions to my CMO, ask questions about raising private money to my chief investment officer, or team building to my chief HR officer. So they're available for you 5 days a week. Any questions that you have, any hurdles that you're facing, anything that you need, these guys are available to help you break through any sort of barriers and take your business to the next level so that way you can build a business that is designed to feed your life and your lifestyle. So if you're interested in learning a little bit more, check out legacyboardroom.com.
So what else could you do? What else could other people do? Obviously, they're improving the properties more.
Yeah.
Are you offering any sort of terms when you're selling? Are you getting creative? Are you saying, hey, go and get, the highest loan you can, and we'll sell or carry 10% of it, or we'll give you back some sort of credits at closing? Are you guys offering any sort of seller? Like you see it with a lot of the builders right now, dude, the builders are just financing it themselves, and then they're taking the debt and they're selling the paper on the market. So they might sell a house instead of getting 250 with today's interest rates, they might market it at 299 with seller financing at 3.99% interest rate. And people are like, oh my gosh. And they care more about the payment than anything else. But then they can take that paper and they can sell a $300,000 note at a discount of $260,000. They're still getting their 250 plus on it. And then the investor that comes in has $40,000 of upside, and they're making an extra 15% on this paper by buying the note. Have you guys ever considered doing anything like that, or doing like wrap mortgages, or
on
anything
stuff
along
that
those
we
lines?
on stuff, so they're on two different sales sides. So rentals that I've had for instance, I have this blanket loan with 10 different properties in it. Me and the appraiser I actually went with the appraiser to go and through these 10 properties. One of them was completely destroyed, and he's like, what am I supposed to do with this? I'm like, yeah, we're just not gonna we're not gonna put this in a loan. So we just threw it out on the market, let another investor grab it up, and then we're gonna do a carry back on that one. So
Yep.
on that stuff,
So you're doing it on more investment side properties, not to owner occupants, right?
Right.
Because
But
there's
on the owner
probably
occupant side,
is the Dodd-Frank stuff still like a big deal with if you sell or finance like an owner occupant a property, that's an issue, right? Like you can't
yeah,
do
that's
that
an
for more
issue.
than 3 or 4, otherwise you're a mortgage broker
Right.
or a mortgage lender, I guess.
So yeah, and then you got to look too on like the actual flip side. If we're buying something for, let's say, 175,000, putting 50 grand into it, and it's worth 275. We've got we're in this thing for 75 to 80%. Then you've got your 6% fees. We've only got 15% to play with. That's our margin, right?
Yeah.
So any correction, right now we're at 10%. That's a 5%. So there's just not enough math to even make something like that work. But I mean, we're
you got to
offering
keep some of the juice
concessions.
in, man. I mean, it's just that's part of the deal. We've had to do that on a couple properties that we wanted to sell that were out of state or too small or whatever, and we either left our profit in or a portion of our cash as well, which is a little bit more painful. I think usually you just want to take all your chips off the table at least,
Yeah.
and then maybe you let the the money you earned, right? The profits, let that keep on riding, and that's okay. It's less painful, but there's definitely been more creative. I was on a phone call for 45 minutes yesterday with a commercial broker talking about, these, even the big buyers. He's got some guy who's got 100 million liquid, but doesn't want to bring almost anything to the close. Wants to bring $1 million at most to closing on buying a $25 million deal. I was like, dude, 4% down, is that's what they're, that's what the going rate is now? Like, come on, man.
Come on, man.
But I mean, it's, people are asking for it, and I think they're getting it. What are your thoughts on where the market's headed, right? Like right now, there's this, it seems like the general consensus is like status quo. Things are still quirky. Things are still weird. But you've heard about the supply deficit, right?
Yeah.
On single family homes. You've heard about the supply deficit on all affordable housing, including multifamily, mobile homes, all that stuff. There's just not enough places for people to live, which is why, inventory is still low and it's still technically a seller's market. When do you think that's going to really start showing itself, where prices start rising, rents start rising? Do you think it's because there's still product coming online in 2025? And do you think that when that dries up towards the end of this year, in 26 and beyond, do you think it's going to get really, really constrained and help out with rents and values?
I can tell you what I'm thinking and how I'm acting to prepare for a couple different scenarios. So, number one, I'm refinancing as much stuff as I can right now. In my belief, rates are going to go down in the next, couple of years. I would say at least two.
You think they're going to keep on going
maybe
up?
2.5. I don't think they're going up. I just don't. I think we're going to see, a high 6 to a 7 in front of the number, right?
Yeah.
Unless the economy goes to complete shit, which, I mean, we had that thing where.
Yeah, but dude, the
the
job numbers, yeah, I mean, if inflation goes up, then they're going to want to increase rates. But if the job numbers keep on going down, which, by the way, the government just let go of friggin' 10%, right, of people opted in for this, let me leave and get paid through September. So all of them are getting paid, not really looking for jobs, but then they come online at the end of September or whatever it is of this year. And there's going to be this influx of a bunch of people who don't have jobs. So when that happens, they're not going to raise rates. But will they? I don't know if they're going to lower them, because I do think inflation's not done yet.
No, I don't either. And so what I'm doing is I'm trying to lock in as low as rates as I can with the
Love it.
with the least amount of prepayment penalty I can. That way I'm getting my cash off the table.
Brilliant.
The other thing I'm seeing too is people that have started real estate from I would call it 2020 to today are hurting. I mean, the amount of portfolios I've got sent over of a package of 10 or a package of 30 or whatever, and they think that dollar amount's still, what you would sell these things to an owner occupant is. Dude, there's two completely different numbers. And these guys aren't cash flowing, right? Because the property taxes went through the roof. People, like, we've kind of figured out the insurance game on our stuff. Like we've talked about in the Mastermind with some self-insurance stuff and going through different brokers, whatnot. But then you have all these other factors with labor and not being scaled correctly. Like, a lot of these guys are, I mean, they're in bad shape. So for me personally, I would love the opportunity to help them out in the future by just being as liquid as possible. Moving into the next year, 2 years, because I mean, all I'm hearing in every RIA and every, thing like this or whatever, like when I have a real conversation with people, they're like, how in hell are you surviving right now? Because like, this happened, I had this roof go bad, this sewer line go bad, and like the cash flow is gone, I had to dip in my savings. But I'm hearing that story again and again and again. So I don't know if hedge funds and Wall Street comes back in, because they're definitely not buying right now. So I don't know when they come back in, but it's probably looking like 1.5 years, 2 years when they know the interest rates are on the path down. But that's kind of how I'm preparing. I'm not like overbuying right now. I'm being very cautiously optimistic, if that makes sense. And just taking deals if it's a great deal, smoking deal, great. I believe in the single family house over the long term. We've talked about this. I think just because we can't build it, I mean, if you are in the circle of your city, I believe that every single house should be worth at least 300 grand, no matter where you're at. If you're in a major metro. So with that thesis, dude, if I can just hang on for the next 3 years, that's 300 grand on every house, right? should be, but you got to have a longer term horizon. You can't just, think today, tomorrow. You got to think 3, 5 years in the future.
For sure, dude. And I agree with
So
that
yeah.
100%. You just can't build them, right? And with tariffs, what's that going to do? Um, it's going to increase the cost of construction, and it's going to continue going up. And there's not going to be a house inside. I like what you said is inside the ring, right? Every city, every metropolitan area has that freeway system that goes around the
Yeah.
city. And as
Yeah.
long as you're inside of that, inside of the inner belt system, dude, there's not a house under $300,000, or there probably won't be in the next, definitely by the end of this decade, maybe as early as next year, end of next year. So, if you're not collecting those properties or flipping those properties or, improving those properties, that's where you're going to get your lowest basis for a single family house, or lowest price per square foot, which there's going to be a big movement towards renovating existing and older homes and then bringing those on the market for lesser than what a new construction home is. And even if you're a builder, like, dude, I'm building townhomes, right, that I could sell for 250, maybe 275 a door. They're appraising from a rental perspective around 210 to 220 a door. But dude, I'm just holding on to these things because I know they're all going to be $300,000 a door or more in the next just couple of years. And so rents, dude, our rents in some of our markets are growing by 5% every 6 months right now on some of these new construction type homes. So even from a rental perspective, I know that they're going to be worth 300. I think from an owner occupancy, 350, who knows? And I might sell, but I also might not. I might just hang on to it. I'm doing the exact same thing. I'm putting interest only debt, usually CMBS. I'm getting the highest leverage, interest only, 5-year term with the most agreeable prepayment penalty possible. Usually it's a step down where I plan on holding it for at least 3 years, and then my prepay is 2% of the loan amount or whatever. But it allows me to grow rents over time, keep my costs down. I'm not paying down any principal, but it keeps my basis or keeps my monthly spend down, and allows us a little bit more cash flow and liquidity and agility in the marketplace. And I think it's working out pretty well for us on those assets right now.
But there's no blanket statement, like even in Columbus, A-class apartments are everywhere. There was one that just got major headlines, just got foreclosed on. $50 million building. The guy just happened to be there on the right day, knew the bank, ended up buying it, I think, for $7.2 million. It was completely vacant. Completely. So, I mean, it's a freaking shell, $50 million shell. But a lot of these things are not filling up because the rents just because there's so many, right?
Well, dude, I just saw a statistic that there's more commercial defaults today than there were in 2009 on commercial property. Now, that's not foreclosures, but that's properties that are in default. There's obviously a lot more properties today than there were in 2009. So it's not proportionately the same, but dude, there's a lot. And I think there's a play for guys like you and me who, unfortunately, a lot of these guys who came in 2020, 2021, 2022, market was easy. Dude, everybody was giving money to real estate. There were deals all over the place. Of course, sellers who had been in the game for a long time wanted to sell because they knew the prices were at a premium. And all these folks came in, but they never built the muscle, right? You own a gym. You know what it's like. Imagine us going to work out, and dude, you're spotting me and I'm benching 350 pounds, but I got you on one side and I got another some guy from your gym who's a total meathead, spotting me. Right? And so I'm good. I can lift that 1,000 times as long as I got spotters. As soon as those spotters go away and I got to do it myself, I never really built the muscle. And so now, dude, this thing's choking me. It's on my neck and could potentially kill me. And I think that's what's happened with a lot of these newer investors who came into the market and never built the muscle, and they bit off more than they could chew. I mean, dude, I know how difficult it is for my business, and I have a big ass team, and I did build the muscle, and I have all the resources, and I have access to private money, and I know what I've had to deal with. I can't imagine somebody who didn't do that. And I've seen this in Ohio. There's one group who's given back 6 or 7 deals. Good guy, right? And just started handing back property. And once the first domino fell, man, all of them started falling. And I've seen it in Texas over and over again with a couple of different groups. And I think there's a play, though. There's this thing out there called rescue capital that kind of became a thing over the past couple of years of the investors facing these pain points. If you and I are going out to the local REI events, right? REIA events.
Yeah.
And we're going to lift different masterminds and people are in pain points, and we can step in, maybe inject a few dollars in order to stabilize these assets. I think we can step into 50% plus ownership position, or 75%, maybe 100% ownership, telling them leave their debt in place, leave their equity, their investors in place. I'll bring new cash and make sure that this doesn't go to foreclosure. I'll save your credit. I'll save your reputation, and I'll get as much of your investor capital back as possible. After I bring this money, I pay my investors 12 or 15%. I make a spread on that. And, here's the game plan for the next 36 months. We're going to ride this thing out. Dude, I think you can get into some deals for very little down and take a very big position and kind of reset the clock on the deal and let it ride for another 5 years until things do kind of stabilize and settle. And we know what's going to happen with tariffs, and we know what's going to happen with interest rates, and we know what's going to happen with all the pending defaults. But I think there's an opportunity there to go snag up some good properties in good areas that just need managerial efficiencies and maybe just a couple of bucks. And somebody's already, squeezed all the juice out of their investors. They can't get any more. Guys like you and I can step into a position where we can get some really solid deals without that much money out of pocket, with having a big position, and just paper it properly where, I'll refinance this thing out in the next 3 to 5 years, and I keep 100% of the ownership. And now all of a sudden, there's a buying opportunity for guys like us.
Absolutely. It's so funny, man, as you're talking. 3 years ago, all we talked about is deal flow. Can't find deals. So hard to find good deals, right? And no one talked about raising money or good management. But when shit starts hitting the fan, if you know how to manage correctly and you can find money, right? The deals are going to be everywhere. So one of the things I'm personally doing is, I'm building up my construction arm, right? We have 26 guys now that are in the construction. We have 2 guys full-time HVAC now. That's something we talked about like 3 years ago, is the whole HVAC thing. We have full-time plumber, certified plumber on staff. So being able to grow those arms and being able to actually do like full gut stuff and not having to pay the premiums on some of these trades, that's great. But being able to have the construction, being able to have the property management, all the systems and all that stuff in place. And I know like damn well we manage, especially on the single family side. I mean, I've had buddies that have been on our calls and all, and they're like, you go that in depth and detail on your management. Yes, absolutely. But especially in times like these, you have to be able to manage better than anybody, right? Mm-hmm. You got to pay attention to it. So I think at times like this, like you have money, you have access to capital, and you can manage, and you have the guys that can swing the hammer.
The world is yours.
Dude, you got it made. Yeah. The world's yours, man.
Infinite amounts of property
You're
right
like,
now.
Here,
Infinite amounts
I can
of deals.
save you. I can save you.
You got to be okay with getting into older vintage properties, right? You got to realize there's going to be more maintenance stuff going on. But at the same time, dude, those are probably the properties that are going to appreciate the most, and rent's going to grow the most. Like $700 a month in rent is so cheap. And if you can get into some properties for 70, 80, under $100,000 a door, dude, there's no way that those aren't renting for $1,000 to $1,500 a month over the course of the next couple of years.
Easily. I mean, dude, where do you even get $1,000 a month anymore? I mean, our cheapest rent on a 2-bedroom house is $1,350, and we priced it like $1,342. We'll do like a 9-month term to be able to turn that lease over in 9 months instead of 12.
Yeah, it doesn't exist, right? It's hard to find unless you're in like tertiary markets, almost rural type of markets. It's hard to find. And like anywhere else, man, it's going up. And I think, again, just like in single family, you can't build it for under 300 a door. Multifamily, you can't build it for less than 150, 175, probably 200 for most people. If you didn't already bank the land and been sitting on it for a while, you're probably in for 175 to 200 a door. So what is that going to do to all multifamily dwellings and multifamily units that are out there that you can snag up in a decent area, B minus area for 80,000 a door, 75,000 a door, 90,000 a door. It's like that stuff's got to go up. It's going to go up in value because it's the only thing that you can attract quality renters at a lower cost basis. And then once they're in, they don't have other options. They're not finding a single family home to buy. They're not finding a single family home to rent. They're not moving into a new apartment that's $2,400 a month.
Yeah.
So incrementally, those rents are going to increase by 5% a year, 6% a year, 7% a year over the next 5 years. Let that compound and look at what the rents are going to do and what you're going to be sitting on and what the position you're going to be in 4, 5, 6 years from now. So, yeah, man,
It's good. It's going to be interesting, man. So what do they say? Don't get
it's an
ready, stay
interesting
ready.
time to see.
Stay ready, right?
There's a lot of
so I mean,
stability in the 20 teens, right? From 2012 to 2019, it was just the same stuff for 7, 10 years. And it's everything's been different, dude. Everything's been different for 5 years. It's been like all over the board, all over since COVID happened. And it's going to be interesting to see how it all shakes out because of all the uneasiness and unknowns and speculation that we've seen over the past few years. There's going to be a little bit of a reset. There's going to be a little bit of pain points, and it's going to create a lot of opportunity for people who know what they're doing.
Yeah, and even if it's just a correction, right? And we've seen it like on our sales side. I mean, 5 to 10% across the board. It's corrected, and you could say days on market used to be 5, and now they're 40. Okay, that's a 5 to 10% correction once you factor in money factor. But like if you've built a good reputation, you're a good operator, you're capitalized, you've got good partners, right? Who are asset managers? Like who are they looking to like offload these properties to? Like if you're taking a property back, are you gonna like put it? No, you're gonna call your 5 people and get it the hell off your books, right?
Yep.
I mean, I've had a couple of hard money lenders that have called us to be able to save their projects, you know.
Yep.
Now these weren't deals for us, but I'm like, yeah, I'll help you on the construction, I'll help you here, or hey, I'll basically help you out on this deal. But like they just want to call somebody. So you got to be that person they want to call. What they say, dig your well before you're thirsty.
Bro, if you can be the problem solver, all the opportunities going to be coming to you. All the opportunities. The lender's going to be calling you. Troubled operators going to be calling you. You're going to be able to snag some pretty awesome deals, but I think you got to be selective also. Don't bite off more than you can chew. Make sure that they're deals that have enough meat on the bone and things that you want to hold on to. And, you got the opportunity to be selective because of all the muscle that you built over the past, 15, 20 years you've been doing this business. So it's awesome to see, man. So let's wrap with this. What's kind of the goal over the next 12 to 18 months for you? What would you love to be celebrating 12, 18 months from now?
Man, staying in business is always a good thing, right? I always say that. Who's that? What's that guy? Dave. He's like, just stay in business, stay in business. I always say that. But no, man, over the next 12 to 18 months, our construction company, I'm looking to basically triple that. So we're running a program now with local investors to where we're bringing the money, we're bringing the experience, we're bringing the construction, bringing the management. And they can own a piece of the deal, and we're basically helping them control that whole, we're basically doing that whole deal, but they get to be a piece of it. So that's going to explode our construction business. I want to build that thing to where
that's one of the biggest. I mean, you're looking at different line items on where you're spending your money and looking at the construction costs of both labor and material, along with insurance is another one, along with some property tax. Like there's a few things that you can really control and some things that you have a little less control over, but construction's a big one, man. I love that. That's a smart
and especially on the rehab side. I mean, it's all the property and construction. That's where your money's at. So that's the big thing for us right now is building that arm. And so that way, we have the construction build up from a revenue standpoint to where if some of these bigger opportunities do come online, I mean, we have everything in house. We're ready. We can take advantage of it, and we have the systems and the infrastructure to handle it. So that's one thing I want to be celebrating. Two, man, I think just we refinanced all these properties, right? And so just sitting on cash, and again, it's just like trying to drill down every little thing that we're doing, so that way when the opportunities do present themselves, like we're ready to go, because I don't know if they're coming, if they're not. So I don't want to say like kind of just floating right now, but like I don't want to be too high, too low. It's just kind of like business as usual with the ability to take advantage of any opportunity that comes along. So
Yep.
that's kind of where I'm at. As what date is it? March 27th of 2025. So that's just kind of where I'm at. So we'll
Love
see
it.
how this plays out over the next 12 months.
Awesome, brother. Well, dude, always fun talking with you. Really appreciate all the value, all the insights that you brought here today. What's the best place for people to connect with you?
Yeah, man. So you can go on Instagram, Tarry Summers. That's Tarry Sums. Some girl took my Tarry Summers handle back in like 2010, or whenever Instagram came out. You hit me up on Facebook. I spend a lot of time on Facebook as I get older. Tarry Summers, Tarry Summers. And then I'll throw out my email as well. It's Tarry@ohiohome.com, Tarry@ohiohome.com. Any of you guys that know me, I'm a complete open book, pretty transparent, and love talking shop, real estate, business, and I love this shit. So yeah, any way I can help out, be a resource, let me know.
Awesome, brother. And we'll share all of Terry's communication and all of his contact information in the show notes. So, brother, appreciate you being here, man. Until next time, we'll see you guys on the Legacy Podcast.
Hey, well, thank you for being here. Hopefully you got a ton of great value out of this episode. We try to give as much free value as possible across all of our social media platforms. So please make sure that you're connected with us. We are at Legacy Wealth on YouTube. We are at Tim Bratz on all other social media platforms, and we're available anywhere that you listen to podcasts. The best way that you can support this podcast is by just subscribing to our YouTube channel, by liking the video, by commenting on it, and by sharing it with anyone else who might get some great value out of it. So thank you again for being here. We'll see you next Sunday on the Legacy Podcast.